Hello, everyone. My name is Sergio Rodriguez, and I am a consultant for Cornerstone Advisors Asset Management. And today, just wanted to create a short video to talk about managing risk by rebalancing your portfolio. I want to go through and talk about what rebalancing is, why it's important, how often you should rebalance and what it means for your portfolio, and some investments that may do the work for you. So rebalancing, really what it is, it's a fancy word for saying shifting assets around within your portfolio. As you can see here on the top right, the definition is rebalancing is the process of realigning your assets back to your desired level. And this can involve either buying or selling securities to maintain an asset allocation you've determined or a desired level of asset allocation or risk. Again, the importance of rebalancing is that it allows you to shift things around to manage the risk within your portfolio. So if we look on the left-hand side here, I included a chart. In this example, let's assume you or your financial professional determine that the allocation you're comfortable with is 65% stocks and 35% bonds. Well, naturally, the allocation can get out of whack depending on market performance. So in this example, the stocks perform well, and now your allocation is 75% stocks and 25% bonds. Well, that's obviously a little bit more risky than what you've determined you're comfortable with, and you'll need to rebalance back to your target in order to manage the risk. So this would involve shifting some of your assets from stocks over to your bonds, or it can involve adding more money to the portfolio and just purchasing more bonds in this example. We'll talk about here why it's important. As I showed on the previous slide there, the risk level of your portfolio can change over time, especially if you don't rebalance over the years. By rebalancing, that allows you to manage the risk within your portfolio. Again, to go back to the previous example, if 65% stocks is where you're comfortable with, and now you're at 75%, you're taking a little bit more risk than you're comfortable with, and rebalancing allows you to manage that. It also allows you to stay on course to reach your investment goals with a smoother ride. And what I mean by that is allows you to manage volatility within the portfolio and hopefully see less of those ups and downs within the portfolio. It also allows you to lock in gains, right? So back to the example on the previous slide, if your equities outperformed your bonds and you're overweighted in equities now, well, you can lock in those gains. In that example, 10% of the equities you made can shift back to bonds. And bonds are considered a little bit more conservative, a little bit more stable, and good assets to have to hedge against your equities. So again, in that example, you're able to lock in some of your gains by shifting your assets around. As the years go by, obviously, your risk tolerance may change. You will be in different life stages, which you can manage the risk by rebalancing. And an example that I have here would be approaching retirement. Many times when we get closer to retirement, that is a stage when we consider dialing it back. And by rebalancing, you can potentially, make your portfolio a little bit more conservative. So that's something to consider as the years change. Maybe your risk tolerance changes. You can rebalance back to your target. It also allows you to buy low and sell high. Right? It allows you to buy an investment at a low price and potentially at a future date when you rebalance, sell high, which is always the goal when investing, right? So rebalancing, again, it allows you to shift your overweighted assets to the underperforming assets, buy low and potentially sell high down the line. And in my opinion, the biggest point here that stands out is that it may help you avoid being overweighted during market downturns, right? So 65% equities is where you're comfortable with, and you're at 75% and the market underperforms, well, you're probably taking a bigger hit than you anticipated. So always keep that in mind. You should rebalance, in my opinion, at least once a year. Some clients may rebalance more often, some, not as often, but you have to balance the risk that you're comfortable with. My recommendation would be at least once a year. You also want to consider changes in your specific life goals. If you have a goal coming up, maybe sooner than you thought, that may be a chance to rebalance to maybe become more conservative. Or the other way around, if you think you can become a little bit more aggressive due to changes in your risk tolerance, or some of your long-term goals, that may be an opportunity to rebalance as well as under other significant life changes. While we've talked about the importance of rebalancing and generally believe it's a positive, I'd want to share some things to consider when rebalancing and how you can be strategic in the process. You want to consider mainly the asset location or where the investment is held. So for example, if you have an investment in your retirement plan or multiple investments in your retirement plan, rebalancing in there may be a good idea because typically you don't generate any tax implications when you shift assets around within a retirement plan. But if we compare that to a taxable account or a non-retirement account in this example, you have to weigh how taxes can impact the transaction, right? Because the transaction may be subject to some taxes there. You also want to consider potential transaction costs and fees that are associated with the transactions. Again, as I mentioned, we do believe there's a positive rebalancing, but you want to consider the potential asset location, potential taxes, costs, and fees. We've gone through here and talked about how you would rebalance, maybe how often and why it's important if you're an investor that manages that on your own. However, just wanted to give a quick example of an investment that does the work for you or does that rebalancing for you, and that would be a target date fund. As I'm sure you're aware, this fund may be available in your retirement plan as one of your investment options. And really what a target date fund is a professionally managed and diversified investment. You'll have access to both domestic and international assets and complete diversification. The real benefit in this is that the fund automatically rebalances for you and it aligns with your time horizon. It's usually going to be based on your age or your planned retirement year. And again, the big point there is that it does the work for you. So again, if you're someone who prefers not to have to do the rebalancing and the managing of the assets over the long haul, consider a target date fund. And if you have any questions, we'll gladly answer those for you. To recap, ultimately what we wanted to share is that you should develop a rebalancing strategy. How often you should rebalance really is based on your risk tolerance. My recommendation would be at least once a year, again, but this is going to depend on your risk tolerance. We touched a little bit about the dangers of not rebalancing, that if you don't rebalance, you run the risk of taking unnecessary risks within your portfolio. And I'd like to remind you that no bull market lasts forever. And if you're overexposed one way or the other, when things go the other way, you may not expect the result. And again, just remember, the benefits of rebalancing include managing your risks, locking in gains, reducing the volatility, as well as taking advantage of market downturn. I hope you enjoyed the video. And as always, you can connect with Cornerstone by scanning the QR code that's listed here on the page. Thank you.